Hey guys, it's Mrs. Lamphere, and in this video we are looking at Unit 10, Section 3, which talks about financial statements and the liquidation of a partnership. So in our last video we talked about that the liquidation of a partnership meant to end the partnership, but we'll go into more detail about that here in a minute. So financial statements of a partnership, they include an income statement, statement of changes in partners' equity, and a balance sheet. So very similar to what we would see in a sole proprietorship. The only difference is this is typically a statement of changes in owner's equity, but now we call it partner's equity because we're looking at both partners' stake in the business. So these are the key financial statements of a business, of a partnership. And then when we are liquidating the business, or liquidation, it's the process of closing down the partnership business. So when our partnership has ended for whatever reason, maybe one partner wants to move on, or it just kind of came to that point where both partners want to move on, that means they will liquidate or close down the business. This occurs when the entire partnership is terminated. When a partnership comes to its end, it results in selling the assets, paying creditors, and distributing remaining assets. So when we get to the end of our business, we need to sell off everything that we can that's not cash. So like any office equipment, extra inventory that we have, we're going to try and sell as much as we can, and in order to kind of keep from having that as a loss. We also need to pay off any remaining debt that we have, any of our liability accounts. We got to make sure we get those paid off. And if there are any assets left, like maybe there is like a desk left over or some supplies, then you can distribute those amongst the partners. Realization is the sale of assets during the liquidation process. So when we sell our assets for cash, so like our accounts receivable or inventory, that's called realizing those items. We are selling them and turning them into cash. Process of liquidation. So again, first step is we're going to sell all of our non-cash assets for cash. So this would be our accounts receivable, our merchandise, our equipment, all of our asset accounts other than cash is what we're going to sell. And you might be thinking, well, how do you sell accounts receivable? That's not really a tangible item. And what a lot of businesses will do is maybe if they have $20,000 in accounts receivable, instead of keeping the business intact until they receive all those payments, they might sell it to someone else for $15,000. So they could sell it to a company for $15,000, and then that company will go and collect the $20,000, and so they make a profit of $5,000. But it just kind of benefits the partners that are dissolving the business. They don't have to wait around till all of their accounts receivable sell. And then merchandise and equipment are all tangible items that they can sell. The next step will be to add all gains or deduct all losses that result from the sale. So those amounts, whether or not we have gains or losses, we need to add or subtract that from our capital accounts. So say we sold our equipment for more than it was worth, that would be a gain, or more than we paid for it, that would be a gain, and that would be additional money that we could add to our capital accounts. If we sold our accounts receivable and had to incur a loss, then we would have to subtract that from our capital accounts. So we're going to close all of these accounts out by either selling them, and that will affect our capital account each time. Third step will be to pay all partnership debts. So any accounts payable that we have outstanding, notes payable that we have outstanding, we need to make sure we pay those bills off. And then the last step would be to distribute any remaining cash to partners. So there's an example on pages 8 and 9 that we're going to look at here that kind of walks us through the liquidation of a partnership. Okay, so we have this example in our text of Ben and Harold illustrating the process of liquidation of a partnership. So according to their partnership agreement, they share their profits and losses equally, so equally divided between the two of them, and have agreed to end their partnership based on the balance sheet on April 15th. In this scenario, liquidation requires converting all partnership assets to cash, paying all debts, and distributing the remaining cash to partners. So here's their balance sheet. They have $15,000 in the bank. They have $20,000 in accounts receivable, so that's money that they are owed from customers still. They have $40,000 in merchandise inventory. Looking at their equipment minus the depreciation, they have about $90,000 worth of equipment, so totaling $168,000 of assets. Their liabilities, it looks like they have $5,000 that they owe in notes payable, $15,000 in accounts payable, which totals about $20,000 in liability. And then here's how the current balance of their equity accounts look like. So Ben has $94,000 in his equity account. Harold has about $54,000, which totals $148,000, which gives our total liabilities and partners' equity of $168,000. So that's what our company kind of looks like at the moment. The first step in liquidation is to sell all non-cash assets for cash. So like we said, that includes the selling of accounts receivable. It looks like, so they sold accounts receivable at a loss, sale of partnership merchandise at a loss, and sale of equipment at a gain. So let's look at what these transactions would look like. So this is the sale of partnership accounts receivable at a loss. So consider that Ben has sold his $20,000 of accounts receivable to a finance company for $19,000 on April 2006. The sale of the accounts receivable has resulted in a loss of $1,000 to the partnership. That is $20,000 minus $19,000, and so they need to divide the loss equally. So again, they had this $20,000 out in accounts receivable. They sold it to a finance company that said, hey, we'll pay you $19,000 for the $20,000 worth of accounts, and that's going to give that finance company a $1,000 revenue, right, for taking over the responsibility of collecting those bills. So, which helps Ben and Harold out because they're not out $20,000. They actually only lost $1,000 by selling it for $19,000. So here's what that journal entry would look like. We received $19,000, so that goes to our cash and bank. We had to incur a loss of $1,000, and we said the loss is split evenly by our partners. So Ben, we are debiting his capital account, and a debit to the capital account decreases our capital. So we are debiting the capital account for $500 and debiting Harold's capital account for $500. So, and then we are crediting our accounts receivable. So our accounts receivable is getting paid off because of this finance company buying $19,000 of it, and then our two partners pitching in at $500 apiece, which completely pays off that accounts receivable. So we credit accounts receivable, that closes that account out, but keep in mind our debits and credits still need to equal. So we received $19,000 in cash and $1,000 in total from the partners, which makes our debits and credits equal. Okay, so then they went on to sell their merchandise, and it looks like they sold their merchandise at a loss. So Harold sold his merchandise inventory, which costs about $40,000 for an amount of $34,000 to a discounter. The sale of merchandise inventory has resulted in a loss of $6,000 because they had $40,000 worth. They sold it for $34,000, so it's a $6,000 loss to the partnership. According to the agreement, the partners have divided the loss equally. That is, both partners will incur a loss of about $3,000. So again, here's what that journal entry looks like. We received $34,000 for the merchandise inventory. So we debit our cash and bank because that's what we got paid. And then the rest of it has to come out from our capital accounts. So we debit each of our capital accounts, decreasing those capital accounts, and that closes then our merchandise inventory. $40,000 in credit, $40,000 in debit, we're good to go. Okay, so then they sold their equipment at a gain. Assume the partnership owns equipment that costs $95,000 and has accumulated a depreciation of $5,000. So the book value is $90,000 worth of equipment. On May 8th, Harold sold the equipment to a trader for $94,000. Therefore, the transaction resulted in a gain of $4,000. This gain is to be divided equally between Ben and Harold. So this is what that journal entry would look like. So we got a gain on this transaction. So first they record the accumulated depreciation, and then they record the cash in bank. So we received $94,000, and that gain resulted in $2,000 a piece credit to our capital accounts. We're increasing those capital accounts, and then we're closing that equipment account of $95,000. So we're crediting that asset account. Okay, so again, this is what it looks like when we have a gain. Our capital accounts increase. On the last two, they were decreasing because we had to incur a loss. Okay, the last step then is payment of partnership liabilities. So that was our notes payable and our accounts payable. So consider the following business transaction. We mailed a check for 104 to the bank note to pay off our notes payable, and we wrote 3 more checks to pay off all of our account balances with other creditors. So here's what that looks like. We paid off our notes payable with $5,000. We paid off our accounts payable of $15,000. So we debit those liability accounts to show that they're decreasing. We're decreasing what we owe. And then cash in bank, we also decreased cash in bank. So we credited cash in bank because we paid $20,000. So that's what those journal entries look like. Okay, so once we've sold off all of our assets, we paid off our liabilities, so now we have 3 accounts left open. We have our cash and bank account, we have Ben's capital account, and we have Harold's capital account. So you'll notice in our T accounts, we recorded all the transactions that just took place. So we had a balance of $18,000. This $19,000 shows the accounts receivable that we sold and debited our cash and bank account. The $34,000 is the merchandise inventory that we sold, and the $94,000 was the equipment that we sold. So we put all those debits together. We lost $20,000 when we paid off our liabilities, so we add that to our credit column, which gives us an ending balance in our cash and bank of $145,000. We added up all our debits, we subtracted our credit, it gives us a debit balance of $145,000. Ben's capital, same thing. We had a balance of $94,000. We had to debit $500 when we took a loss on the accounts receivable. We had to debit $3,000 when we took a loss on merchandise inventory. And we got a credit or a gain when we sold the equipment. So these symbols are backwards. We all know that a capital account increases on the credit side, decreases on the debit side, so don't pay attention to those. But that gives us an ending balance of Ben's capital account of $92,500. And Harold's is kind of set up the same way. He had a lower balance to begin with, but we still take out the same amounts for debit and the same amount for credit. That leaves him with a balance of $52,500. And so the very last step then is going to be the distribution of cash. So on May 16th, the partnership is terminated by distributing the balance of cash in the bank to Ben and Harold. So again, they agreed to split everything 50-50. And so that's what they're going to do. The journal entry for the final transaction to end the partnership will be displayed below. So we are closing out our cash in bank, and we are debiting our capital accounts. Let's look at that, because we're closing out those capital accounts. So we had balances, we had credit balances in our capital accounts, so we're going to debit those in order to close those out. I'm just looking over this last information here. Okay, so let's take a look at the assignment for today, and I'll help you get started. So for the assignment in part 1, Hooks and Franklin are in the process of liquidating their partnership. They share profits and losses in a ratio of 3-to-1. So that should tell you that Hooks is getting 3/4 of the shares, and Franklin's getting 1/4 of the share because we add those together. If you're confused by that, review the video from Tuesday, the previous lesson. They have sold all the non-cash assets of the partnership. The transactions for the sales are as follows. So on May 15th, they sold their equipment with a book value of $10,000 and was sold for $12,000. So that should tell you right away that they got a $2,000 gain there. Accounts receivable was worth $7,000 and they sold to a broker for $6,800. So that kind of shows us they have a loss. And May 20th, their merchandise inventory, which cost $3,000, was sold for $1,900. So that's another loss. Record the journal entries for the sale of non-cash assets by using the general journal. Remember that the journal entries have to be made for both gain and loss. Past journal entries separate for each transaction. And highlight the gain or loss in the general journal itself. So first we need to go through and kind of make these calculations. So we need to determine, was there a gain or a loss on the sale? So for this May 15th transaction, we sold our equipment. It had a value of $10,000. We sold it for $12,000. So that tells us we got a $2,000 gain. So then we have to calculate each partner's share. We know Hooks has the 3/4 share. So we're going to take 3/4 times 2,000 in order to figure out his share. And then Franklin has 1/4 share. We're going to take 1/4 times 2,000 to figure out his share. And let's go ahead and calculate that real quick. We have 3 divided by 4 equals 0.75. Take that times 2,000. Actually, times 2,000. Oh, yeah, actually times 2,000. Here we go. Sorry, I was thinking about something else. So 0.75 times 2,000 gives us $1,500. So Hook's share is $1,500 of that gain. And then Franklin's share, we take 1 divided by 4 times 2,000 equals $500. So we have $500 then going to Franklin for his share. So that was the gain, and that's how it looks split between both partners. So for the rest of these problems in part 1, the next one, they sold accounts receivable for $6,800. So that's a $200 loss. So now you need to go through and do the calculation and determine Hook's share of the loss and Franklin's share of the loss. And then same with this last one. Looks like there was a loss of $1,100. So you need to, again, calculate the share of each partner's loss in that transaction. So then you're going to journalize each of those transactions. So I'll do the first one with you. We were paid $12,000, right, for $10,000 worth of equipment. So we want to list all of our debits first. So our cash in bank is going to increase by $12,000. And then the rest of our accounts are going to, well, our capital accounts are going to increase as a credit, right? Our capital accounts increase on the credit side. So we're going to credit Hook's capital for $1,500, credit Franklin's capital for $500. And then we're also going to credit our equipment account because we're closing that equipment account for $10,000 because that was the value that we had in there for our equipment. So we have Hook's capital. We are crediting for $1,500. Franklin's capital, we are crediting for $500. And then we have our asset account equipment. We're closing that account out because we sold it all. And we had $10,000 worth of equipment in our books, so that's what we are crediting that account for. And again, you want to make sure your debits and credits equal. So we have $10,000 in debits. $1,500 plus $500 is $2,000 plus $10,000 is $12,000, so we are good to go there. To kind of give you a hint, I'm going to have you do the rest of these on your own, but you should have balances here in your debit column and your credit column of $22,000. So do the rest of those transactions on your own. Keep in mind, this was a gain, so we credited these accounts. If it's a loss, you're going to be debiting those capital accounts. So keep that in mind with those next two transactions. In part 2, Rex and Jack's Novelty Store, a partnership business, has planned to liquidate. Your task is to help them liquidate the partnership. Listed below are the remaining assets and liabilities of the business. Rex and Jack share all profits and losses equally, which is nice. We just have to divide it by 2. We have cash in bank, $20,000. We have $12,000 of accounts receivable, $42,000 of inventory, and $60,000 of equipment. Our accounts payable, the amount that money that we owe to different creditors, is $15,500, and we currently have even balances in both of our capital accounts of $59,250. So with this liquidation, the customers will have to pay their accounts in full before the liquidation date, and the full amount is received. So our accounts receivable, we had a balance of $20,000. It says we actually received, accounts receivable was $12,000 balance, and it says we received the full amount of our accounts receivable. So since we received the exact amount, that's neither a gain nor a loss, so it's actually not going to affect then our capital accounts. It's only going to affect our cash in bank, because we received that $12,000, and then it's going to affect our accounts receivable. So we are closing that account by crediting it for $12,000. So again, since there was neither a gain nor a loss, it does not affect our capital accounts. The next bullet point says merchandise inventory was sold for $40,000, resulting in a loss of $2,000 to the partnership. So now we have to record a loss. So again, we're going to go down to our journal. We're going to start with cash in bank. We sold the merchandise, and we received $40,000. But we had to take a loss of $2,000. So again, this has to come from our partnership's capital. So we have, this is Rex. We said, let's see, sorry, I keep forgetting what we said. $2,000 loss, and we said we're dividing this loss evenly between our partners. So that's going to be $1,000 coming out of Rex's capital and $1,000 coming out of Jax's capital. And then that closes out our merchandise inventory. We've had a book value of $42,000. Okay, so you can finish these last 2 bullets on your own. And then the final step, and I'll give you what the total should be for each of these columns here for your debits and credits. That can kind of help you out with your journal entries. So then the final step then is to show the ending balance of each of these 3 remaining accounts. So what you'll do is fill out these T accounts based on the transactions you've recorded. So we started out with $59,250 balance in our capital accounts. We can stick that in the credit column because that was our balance. And we had $20,000 balance in our cash and bank. And so far, we have this transaction that affected our cash and bank. We debited it for $12,000. And the next transaction affected our cash and bank, the debit of $40,000. And affected our capital accounts by debiting them for $1,000 each. So we're going to put that in the debit column. Okay, and so as you go through and make the rest of these transactions in your journal, you're going to copy how those affected the capital accounts and the cash in bank so that you can get the total for each of these accounts. And I'll go ahead too and give you what your balance should look like when you get done with these. Okay, so you have to still fill in the rest of the amounts. You should have an amount. Let me just highlight the cells for you. You should have an amount here, and you should have an amount here in your cash and bank. Oops, and this is not the correct balance. It should actually be on this side, 126,500. So you still need two numbers that are going to affect your cash and bank. You still have one amount that's going to affect your capital account. And when you're done, again, you should come up with these balances for each of these accounts. And then you're going to want, this will be your fifth and final transaction. So you'll have these 4 transactions up here, and then you're going to close out these final accounts, and that's going to be your 5th transaction in our journal, and that will leave you with a total, these balances of each column. Okay, that is all I'm going to do for you on this assignment, so hopefully you can get the rest of that figured out on your own. If you have any questions, please let me know.